It's Brian Preston, the money guy.
The growth in earnings. So this is one you've heard us mention, price to earnings ratio. If you just want to understand that formula, it's exactly what it sounds like. The price of the stock market or the individual holding,
Right.
divided by the earnings. And the key component of that is earnings, and that's the driving factor. I mean, when I'm talking to people and they ask me about the stock market and they ask me, why should I be a stock investor in general? I go through how exciting it is to be alive right now because, and there's all kind of quotes I could have pulled down from Steve Jobs, from him, from Warren Buffett, who's a great investor, where we have so much innovation going on out there in the world. If you think about just your iPhones, you think about Teslas, you think about just Google, Amazon passing all the things they've done with their Prime and all the content, Netflix. It is an incredible time to be alive. And if you looked 20 years ago, all those companies I just mentioned
weren't around.
They weren't around. And now they impact every day of our life. So innovation is an incredible thing. So investing is not a zero-sum game, meaning that you don't have to think, I'm buying into something and it's got to get it at the perfect time. But it does help if you understand that what drives the economy in general is this capitalistic marketplace. It's as Adam Smith, who wrote Wealth of Nations, which, by the way, if you didn't know, was written within a decade of the founding of this country back in the 1700s. It's that invisible hand that is making innovation, driving profit, and other things to where earnings are increasing, always increasing. So you need to understand, if earnings are increasing, what is this? How does this impact my investments, and what's reasonable, and how does this play into it?
And the hard thing about earnings is that it's really easy to look backwards and kind of see what earnings were last year, but it becomes much more difficult to look forward and determine what our earnings are going to be. And so what we try to look at when we think about valuations and look at investing is, how has the change in earnings moved? Are earnings increasing or earnings decreasing? And so that's kind of the metric we have to look at and assess.
And opinions vary. So let me give you an example. I'm going to look at right now the stock market.
Okay.
So we have the S&P 500. Listen to this. Let me give you one side of the coin, and then we'll flip the coin over and give you the good and the bad. So the bad of the current stock market is that profit margins are at an all-time high.
It means companies are making really healthy margin on the revenue that they're generating.
So so then the next thing is the current trajectory of earnings is not sustainable. So it ties into the first thing I said. So if we're at all-time highs on our earnings, how can they keep at this growth pace that they've been at for the last few years? So that's the negative. Here's the good for the people who are very bullish on what's going to happen with the financial markets. It says low interest rates.
They are still, even though they're moving up a little bit, they are still historically low. No doubt about that.
New tax law.
Could be huge for corporations, especially given corporate tax reform.
Taking rates from corporations from the 30s down to 21%, that's a material change. Productivity benefits of technology. You just heard me talk about all the new technology companies and how they're changing our everyday life. They've also increased productivity per employee as well. So that's the good and the bad. So you can see if you're getting multiple opinions on the exact same market, it's kind of like, that whole exercise that you've always heard people talk about, where you take a group of people and blindfold them and then have them feel an elephant. They're all feeling the exact same elephant, but they're describing different parts of it. You don't get a clear picture of what's going on.
Never heard of that experiment.
You've never heard that?
Is that a real experiment?
No, yeah. I've read it. I've read about it years ago. I'm sure I'm screwing up. I probably should have colored them pink or something else. But yeah, you have some, there's been discussions where you could have people, even though they're describing the exact same thing, if they're at the different parts of it, or they're looking at it differently, you're not going to get the same description and not be able to tell. So we need to give you some understanding historically. What is reasonable? So historically, earnings increase at about 6% a year. That's the historical average, but they range between 3 to 10% if you're looking at. So what I mean by that is, if you have a company, if the stock increases earnings by 10%, you can understand that the valuation of the company can also increase by some factor because the earnings have increased. So that's why you do want to make sure you understand what is going on with earnings. Now, a word of caution about earnings. You've heard us talk about, when you're doing any type of investing, that usually about 8 out of 10 years or 80% of the time, markets are good.
That's right.
That's a great thing. That's 8 out of 10 years. We're at 80%. That's incredible odds. But there are periods when you hit recessions, when you hit bear markets, where you can see earnings actually constrict.
That's right.
So I just want to tell people to be careful because earnings on rare occasions can be negative. So this is not a tree that grows to heaven. You do need to be mindful of what is going on with earnings.
And that's pretty common sense. If you've ever worked for a business before, you know that your goal next year is to make more money or be more profitable than you were this year. But that doesn't happen forever. There are down years. On the converse side, you can't work for a business that makes less money each year because eventually you run out of money. And so it makes sense that it's sort of the cyclical movement that happens in earnings.
I want to kind of close out our discussion on earnings so we can move on with it. The understanding is because this is a basic investment thing that you need to understand. When you see announcements come out on the market or a stock, you'll see that they blew the earnings out of the water, but then the price still goes down 10%. You go, what happened? They beat the earnings per share by 10%, but yet somehow the stock is down 15. What happened? Well, what happens is that the stock market is always forward looking. Mm-hmm. It is a few months out or to a year out. So it's not uncommon that you'll see somebody who has earnings that they beat, but then they give guidance that over the next 12 to 24 months that maybe earnings are not going to be as strong looking forward.
Right.
And that's what the stock market's paying attention to. So be very aware that you need to be mindful of what's going to happen at the point in the future. The growth of the earnings rate is very important.